Hey, it's Soleil, and this is episode 29 of the Red Pill to Orange Pill Investor. And I'm going to go over the spreadsheet on how to get to critical mass. I generally try to get at least 1% premium every week. And if you just look at that on its own, getting 1% a week is 52% for the year. So it's already pretty sweet compared to just buying and holding SPY or whatever. But some of these volatile stocks you can get even more than 1%. So if you sell a covered call and you have 100 shares and you collect 1%, you can buy one additional share. So it will take you 100 weeks to get an additional 100 shares, which puts you at 200 shares. But now you're purchasing shares every week at a faster rate. So now you're buying two a week, and it only takes you 50 weeks to get to the next 300. You keep doing that until it takes quite a bit of time to get that last one. But after 573 weeks or 11 years, you would have 10,000 shares. Now, this is like, holy crap, I don't have 11 years to wait. But keep in mind, this is theoretically not putting a single dime into the account after purchasing the original 100 shares. This is just buying 100 shares and then selling a covered call every week, collecting 1% and buying another share. So theoretically, you could get to 10,000 shares in 11 years, but only ever purchasing 100 shares to begin with out of your own pocket. Now, of course, if you add money to your account, you can add shares faster. But it doesn't even, and I say theoretically because if the price goes over your strike, then of course you would have to sell some shares in order to cover that call. So, it's not guaranteed that it would follow this pattern exactly, but this is just for reference to see what's possible. And really, you don't care if it goes over your strike and you end up having to sell some shares at that price anyway, because it's forcing you to sell high. So the only reason that you would be forced to sell some of those extra shares would be if the price went up. So this strategy kind of forces you to sell high. So if you are like, oh, I don't know how to time the market, I don't know when I should sell, you just sell a covered call against it. And if it goes over that strike and you have to sell some in order to cover it, then you sell high. It's kind of an easy peasy way to be disciplined with the strategy instead of just guessing. But yeah, however, I mocked up 5% as well. There have been some really, really risky stocks that I've been able to get even more than 5%, like 7, 8, 9, and as much as 10%. I think when GameStop was doing its run, you could get 10%, maybe even 20%. It was pretty crazy, but the price would crash not long after. there was no guarantee that the price of GameStop would still be the same price by Friday. So the reason why they were paying so much premium is because you could completely get screwed. So that was not something, I don't consider that like a long-term investment. That's basically just playing in the casino, really. But if you look at Mara, on Friday, I rolled to the 18.5 strike, got paid $94. So that's basically 5%. And you can take that $94 and the price was probably 18 or whatever, and you can buy another 5 shares of Mara, and you get to the place where you can purchase 100 stocks every week much faster. Collecting 5%, you only actually need to get to 2,000 shares of a stock to be able to kind of reach critical mass where you're buying 100 shares every week. If you have 2,000 shares and you get 5% return, that's going to leave you enough money to buy another 100 shares. So you can do that in about a year and a half. Now, you're getting 2% return, getting paid 2% premium, 3%, 4%, you know, it would be somewhere in between 11 years and a year and a half. So that's the strategy. And let me just look at HUT. HUT is one that I started messing around with. And actually, I took some money out of Robinhood. I don't know what the deal is with the margin. It said something about I can't purchase with margin because I don't have any brokerage cash, but yet I have buying power. So I have no idea what that means. But anyway, I bought some HUT. I paid $807, sold the 8.5 call. Initially, when I sell my first call against the stock, I try to be very aggressive with the premium. I want to lower my cost basis as much as possible. So really, you can say that I only paid $760 for this because I got, well, actually, what did I get paid? It's worth $47 now, but I got paid, okay, I only got 32 cents because HUT's gone up, so the value of this call has actually gone up. So 805 minus 30, 775. So you could look at this as me only actually paying $7.75 for the stock because I got paid 32 cents for this 8.5 strike. If we're lucky, this will just continue to go up, and that will be fine. But on my other account, you know, I took money out of this account. I'm sending it over to my other account where margin is actually still working. That's a Tasty Trade account, and for some reason, they're more accurately reflecting margin costs. And every stock is different as well, so you'll want to check that out. When I went into Mara, I believe that Tasty Trade was not giving me any margin discount. Tesla, I could basically buy Tesla for half price. I could buy HUT for half price. And I can't remember. It was either Mara or Riot. One of the two would let me buy on margin, and the other one it was charging me full price for it. I have no idea why. Maybe they know something that I don't about each stock. Maybe it's more risky than another. However, that's another thing to consider. If you're like, should I buy HUT because it's so cheap, or should I buy Riot, which is $3 more, or well, should I buy Mara if I can afford it? It's like 17, 18, 19. Should I get Riot or Mara? Look and see, if you're using margin, that is. Margin is dangerous. You can get wrecked using it. However, if you're going to use it, you might as well purchase the stock that gets you the best margin. Let's just take a look at this. Yeah, so initial margin requirement on this was 72%. So they're saying that I should be able to purchase this with like a 28% discount. But for some reason it's not working for me right now. So I put one share in, charging me full price. But in the event that your margin is reflecting, you know, estimated cost will be less than the actual cost of the shares itself. And so if one stock's going to give you a 30% discount, another one's going to give you 50, maybe use that as a tiebreaker to go with the stock that's going to allow you to preserve more of your buying power or purchase more shares. If you can get 200 shares of, well, let's just see, 100 shares of Mara is about the same as 200 shares of HUT. So let's just see, if we sold the 19 strike, 79 cents. HUT. We sell the 8.5, we get 47 cents, but double that would be 94. So it's very similar. But if you're trying to get to the next 100 shares of something, like even if you're selling a covered call in Mara, let's say you had $2,000, and you're going to buy 100 shares of Mara, and you collect that $94, you could still buy 10, 11 shares of HUT because you're going to get to 100 shares of HUT faster than you would get to 100 shares of Mara. And that extra 100 shares, getting to 100 shares of anything is going to allow you to sell another covered call. And so then if you had 100 shares of Mara and 100 shares of HUT, you're going to be able to buy 11 shares of HUT on your Mara call and another five shares of HUT from your HUT calls. So now you're buying 16 shares of HUT a week, and it's only going to take you, 7 weeks or something like that to get to your next 100. So whether you're selling calls on these Bitcoin stocks or Tesla or whatever, if you're selling a Tesla call and getting $200 or whatever, you can buy 25 shares of HUT, take you 4 weeks selling Tesla calls to get your next 100 shares of HUT. So yeah, you don't just have to buy one share of the stock that you're selling covered calls against, and it seems like it makes sense to buy the cheapest stock possible that is going to give you good premium. And just a quick note, why I don't own Apple and sell covered calls against it. There's just not a lot of premium here. So at the money, you can get about a 1.5%. That's very little call away. That's like $1.50 in call away value. So you can get 1% at one strike up, which is actually that's not terrible. I mean, it still gives you 191 to 195, $4. It's about 2% in call away value and 1% premium. Let me see what Tesla is given. Tesla going to 1%, is kind of like right in between these. So that's hard to give a good estimate. But Tesla's not that much better than Apple right now, as a matter of fact, which is annoying. If we split the difference here, that's like 196 and a quarter. So that would be about $4, so 2%. So that Tesla's actually trading similar to Apple. That's annoying as hell. So I was getting a lot of good premium from Tesla, but I'm still a believer in Tesla. So I think it has the most upside, but unfortunately, selling covered calls is all about limiting your upside. But in either case, since I'm a Tesla fanboy, I guess I'm anticipating hitting my call away strikes more often than I would with Apple anyway. I think Apple is more likely to trade sideways for the next 10 to 20 years than Tesla does. Apple's dominant, and so they're going to appreciate. But Tesla, I think, even though I've gotten pretty screwed on the last 4 earnings calls, I think at least, eventually, because I don't carry covered calls over earnings, eventually some of these earnings calls are going to surprise to the upside. And since I won't have covered calls over earnings, I'll be able to capture all of that. But I'm still still waiting for one of those. Tesla's either just done not much of anything or actually dropped over earnings for the most part. So anyway, that's the strategy, and depending on how much premium you're collecting and how many shares you're purchasing, it can take you however long to get up to a point where you can collect enough premium to purchase 100 shares every week. And then you're not just purchasing 100 shares every week, you're purchasing the ability to, you're not just purchasing one share a week, you're purchasing of 100 shares a week, which allows you to sell even an additional covered call. So you'd be selling 101 covered calls after this, and the next week you're selling 102 covered calls and 103 covered calls. And that's the difference between earning 1% a week and earning 1% on 1%. Because if you earn 1% a week, that gives you 52% by the end of the year. But 1% on 1% is 1.01 raised to the 52nd power, which gives you 167%. So instead of getting 52%, you'd be getting 1% on top of your 1%, which would be 67% for the year. Getting 5% is insane. I've not been able to consistently do that, but we can dream, can't we? So yeah, if you collect 5%, you'd 12x your money in a year. If you're getting 5% on 5%, but you have to reach the critical mass stage, so you'd have to have at least 2,000 shares of a stock where you can collect 5% on it, which it seems like you're pretty close to able to do with Mara and Hut right now. So 2,000 shares of Hut at $8 a share is what, 16 grand? Actually, it's actually doable. I mean, even if you can only afford 100, you can still get there in a year and a half. But I'm sure there's plenty of investors out there that can throw down 16 grand. All right, I think that's it for now. Be good, y'all.